Okay, we'll make a start. Welcome, ladies and gentlemen, to this policy exchange discussion on global imbalances and the global monetary system. It's an odd discussion in a way, insofar as it's both incredibly long-running and at the same time incredibly hot right now, very, very topical. As you all know, the G20 in Seoul at the end of last year agreed to develop a series of indicative guidelines which will help to identify the large imbalances that require what they call preventative and corrective actions. Now, what does that mean, and what exactly is it that we should be trying to achieve? In this evening's discussion, I hope that we can touch on quite a lot of different aspects of this big question. What are the root causes of global imbalances? Is it to do with demographics? Is it to do with welfare states? Is it just to do with currency pegs? Are global imbalances going to continue? Will they shrink? Or might they even grow? Andrew Haldane at the Bank of England has recently argued that they might even grow. Are these global imbalances unsustainable? Mervyn King certainly seems to think so. Are they important? Now, some people will just think that they are irrelevant. And if they are important, why is it? Is it for economic reasons or is it for political reasons? Now, if we think that global imbalances are important, we think they're perhaps the root cause of the financial crisis even, what can be done about them? What can we do cooperatively? What would it take? Would it be just a matter of floating the yuan? Or is there something we should even be doing if we think they're a major problem and a cooperative solution is unlikely? Is there something we should be doing to force the issue, perhaps even acting unilaterally? Many, many big questions. Fortunately, we have this evening an absolutely all-star panel of people. They don't really need any introduction. Martin Wolf is the associate editor and the chief economics commentator of the Financial Times. Jeremy Warner is the assistant editor of The Telegraph, previously he was on The Independent. Roger Bootle is well known to all of you as well, he's the managing director of Capital Economics. And Andrew Lilo is the founder of Europe Economics and also, until very recently, Policy Exchange's chief economist. This evening's discussion has very, very kindly been made possible and prompted by both Brit Shaw and also Pi Capital, so I'd like to thank them before we even start. The format this evening is we're going to hear some short speeches, maybe 10 minutes, from each of our guests, and then we're going to open things out for a discussion and questions from all of you. So, without any further ado, it's an absolute huge pleasure to introduce Martin Wolf. Thank you very much.
Thank you very much. Crucial thing is the microphone working. Yes, it is. It's a pleasure to be here. I've had a more than normally insane day, so if I'm more than normally incoherent, I apologise. What I'm going to try and do in this these brief opening remarks, I know when anybody uses the word brief you should be really worried, but I'm normally reasonably efficient about time, and if not, I'm sure the chairman will stop me. I'm going to set out first some interesting facts, very, very briefly. Then I'm going to talk about why any reasonable human being might worry about imbalances, because believe it or not, I do know the economics which suggests that we should regard them with complete indifference. Indeed, I was taught it and believed it for 30 years, unlike my friend Roger, I suspect. What is the link between imbalances and the crisis? How far are they now being rectified, and what are the policy issues now in front of the world? We were asked, I think, to address the question of what the UK should do about all this, and my answer is I don't know what the UK should do, but what it can do is very little. So this is not really a debate addressed to any large extent to the UK government, which is essentially a bystander. Okay, the fact, very interesting facts. After the Asian crisis, and I think the Asian crisis was a very important event, by no means the only driving force, the aggregate of the surpluses of surplus countries in the world moved from being about grew relative to world GDP about 7 times, from about slightly under 0.5% of world GDP to about 3.5% just before the crisis. Extraordinary rise. This was dominated by emerging countries, the increase, and that really fell into 3 categories. The oil countries, and we all understand why that was the case, it's no surprise, nor is it at all unreasonable. China, which was overwhelmingly important, and other Asian countries. There was a long-running surpluses in Japan and a very large increase in Germany. And those are basically the surplus countries. On the deficit side, the overwhelmingly dominant player was the US, Other very large deficit countries were, of course, Spain, the UK, and relative to GDP, Ireland, and Central and Eastern European countries. You will notice that all of these countries fell deeply into crisis. So there is a reason why one might be interested in what was going on here. Okay, that's the factual background. Then why might we worry about this? Well, economics tells us, good old economics, that there's absolutely no reason to worry because there simply are the accommodation of desirable shifts in savings and investment across the world, or income and expenditure across the world, and there's absolutely no reason to worry about that. And if you believe, one, that financial markets largely know what they're doing, particularly when they operate across borders, and two, the costs of adjustment to large shifts in external capital are modest, this assumption is correct. Unfortunately, neither of those assumptions is correct, and that is why when there are large swings in either direction in capital flows associated with large imbalances, one tends to get very large financial and also very large macroeconomic shocks. There's nothing new about what happened in the last few years in relation to it, except that it happened to developed countries. Anyone who'd followed the emerging countries closely would have been completely familiar with this crisis. In fact, it was smaller than those emerging crises, only to the extent that, fortunately, the countries concerned were able to continue to finance themselves through the crisis with their own currency. Now, what is the problem when one gets a sudden, often very sudden shift, and I've indicated how sudden it was, in the desire of foreigners to buy domestic assets? Well, there are essentially three problems. It tends to, or four problems. It tends to lead to, quite naturally and inevitably, you've got a sudden increase in the supply of savings in your economy. I won't go into the global side, too complicated. That lowers real interest rates. It leads, and that tends to have a very strong effect on asset prices. It also tends to lead to an appreciation of either the nominal or the real exchange rate, particularly the nominal exchange rate in a floating rate world, very, very important for US and UK. That tends to lead to lower interest rates from the central bank, which further exacerbate the second big part of it, which is the credit expansion side. Conditions in which are very, very favourable for rapid credit expansion, supported, of course, by the asset price boom. Because you've got an appreciation of either the nominal or of the real exchange rate, either through a nominal exchange rate appreciation or in these conditions often higher inflation, as happened within the Eurozone, there tends to be a shrinkage in the production of tradables and a very rapid expansion in investment in and production of non-tradables, above all construction and housing. So you've got then this huge asset price bubble, huge expansion of investments in construction and housing, large debt accumulations, and often a severe loss of competitiveness. It's particularly severe and permanent for countries in fixed rate arrangements. And obviously, in these conditions, you're ripe for catastrophe when the currency, the exchange flows, the inflows reverse. And that is what's happened to many, many emerging countries. It's what's happened to Spain, it's what's happened to Ireland. It's effectively what happened to the UK. The exchange rate took the adjustment, and also with the US. So that's the background of why I think it is reasonable for people to worry about this, because the assumptions I laid out aren't plausible. Now, what in particular was going on in this crisis? I think there are, so a sort of third big question, what was going on in this particular crisis? Well, I think there are, I'll just focus, as it were, at the global level. I don't think I've got the time to discuss the Eurozone, and many of you are probably very familiar with this. The really interesting feature of this last cycle of external imbalances, quote unquote, and associated surplus and deficits was the role of governments, both via intervention in foreign currency markets and accumulation of currency reserves. Over the last 10 years, global foreign currency reserves have increased overwhelmingly in emerging markets by $8 trillion. This is the dominance form of external asset accumulation by the emerging countries, and in my view, it's an argument I've made, their own savings, then that domestic savings behaviour has been driven in large part by the response to those decisions. There were two reasons for these reserve accumulations: their own experience of many countries, experience many noticed, with their own experience with large capital inflows, so they decided to insure themselves against that by accumulating reserves. But still more important, they made the decision that the only sensible form of growth is an export-led growth, rather than going back to the domestic demand-led growth, which was associated with the tremendous crises they'd experienced in the 1990s, culminating with the Asian crisis. So they pursued this policy. The foreign currency reserves, of course, inevitably went into the accumulation of official liabilities, mainly government liabilities of the United States. Emerging markets became the dominant driver of this, lowering the yield substantially, raising the price of these assets. That led to, in my view, it's not by no means my only view, to a substitution in the demand for higher, with a strong demand for high yielding, notionally safe assets from people who would normally have bought these sorts of liabilities, and that led to the mass fabrication of pseudo AAA assets throughout the US financial system, which were then, of course, distributed across the world. So there is a fairly direct link. This does not mean, by the way, that I'm blaming the surplus countries for the entire mess in any way, but it seems to me pretty clear that that's what was going on, or that was part of what goes on. How far imbalance is now being rectified? To the third question, the answer to that is to quite a small degree, but to some degree. The imbalances, as I've defined them, are now back to where they were in about 2004. They're still very large. There are still very large surpluses in the surplus countries. That means there have to be, by definition, large deficits in the deficit countries. And if you're running a deficit in a deficit country, that must mean, by definition, that your income exceeds, that your expenditure exceeds your income. If your expenditure exceeds your income, there must be sectors whose expenditure is exceeding their income. And since the domestic private sectors in all the previous deficit countries are now radically cutting back, this has ended up with a completely predictable and predicted by me and others massive fiscal deficit. I forecast 4 years ago that the US fiscal deficit could end up at 8% of GDP. When these flows reversed, I was regarded as a certifiable lunatic. Unfortunately, I was much too modest in my expectations, and that is where indeed they've ended up. And these fiscal deficits will be very difficult to eliminate given what's going on in the private sectors without a large correction in external accounts. Let me just say, finally, what more needs to be done? I think it is reasonable, for the reasons I've outlined, to envisage a move to what Keynes wanted at the beginning of the Bretton Woods system, greater policing these surpluses and deficits. That's what the Americans have been calling for, with at least some discussion of policy when countries start running, big countries, really big countries, not who cares about little ones, start running huge surpluses, which have to be accommodated elsewhere in the system. So more policing is a large part of this, at least a discussion. I think the other part of this is that emerging countries need to feel comfortable, and this is a really last point, with a situation in which they are again net importers of capital. Because if you start thinking about where I started with, what is a sensible way to use the world's surplus capital, the obvious answer to that is to use it in the countries which actually have the best investment opportunities and the greatest need. And the craziest thing about what happened in the last 10 years is that we had vast surpluses of capital. And we're talking about 500 or 600 billions a year pouring out of emerging countries and going into the household sector of the richest countries of the world to build houses that nobody wanted or needed. This is the biggest misallocation of resources imaginable, and we need to construct an insurance system that encourages emerging countries to believe that they can risk running large deficits and handle the occasional crisis. Without this problem will not be, in my view, resolved. That's all I have to say. Thank you.
Thank you. Wow. there's a lot there. Jeremy, I think you have a different view.
Yes, it works very well. Of course, the problem with speaking after economic royalties, such as Martin, is that many of the points that can be made have already been very eloquently made. Nonetheless, and this is probably a big mistake, I am going to try and take issue with some of what he said. And I confidently expect to be demolished in the argument over the next hour or so, but here goes anyway. Now what I want to argue is this, that though globalization has certainly made these imbalances much bigger and potentially much more destabilizing than at any stage in the past, they are in fact a simple fact of economic life. The idea that they can be solved through currency reform doesn't seem to me to be right, although it might help. If nothing can be done other than slapping on trade barriers and capital controls about the underlying problem, then it becomes necessary to try and treat the destabilizing consequences instead. It's plainly in no one's interest that developing economy savings are allowed to inflate credit bubbles in the already highly indebted advanced economies again. So we need to push with greater urgency and resolve down the road of international financial and monetary reform. And I'm pleased to say that some progress is being made on that front. Adequate capital controls are obviously the first starting point. There are other solutions. We could put globalization into reverse by creating trade barriers. Maybe that's where we'll end up. I hope we won't. In any case, the idea that imbalances are largely the result of currency misalignment strikes me as wrong. And if only the Chinese could be persuaded to let their currency appreciate by a decent amount, or if only the European Union would go back to a system of free-floating exchange rates, the problem would go away. This doesn't strike me as at all likely. And for this reason, a current account surplus is only the mirror image of a capital surplus, or as Martin has just explained, an excess of saving. And put simply, households and companies, if they save a substantial proportion of their earnings, they will generate a surplus of goods and services. As much of what they produce will be saved rather than consumed. This excess of production will be exported at whatever price the market will take. There are all kinds of reasons why some countries have a high propensity to save, and others, such as the US and the UK, have a low one. And to a great extent, it depends on what stage of development they're at, how rich and wealthy they are, and so on and so forth. But these structural differences cannot be corrected merely through currency adjustment. It's going to take a long time, years, certainly, possibly decades, for China to develop the necessary social safety net and ready access to credit, but that will begin to make serious inroads into its propensity to save. Let's just briefly consider what would happen if China did agree to US demands and revalue its currency by, say, 20–25%. It seems to me very unlikely that this would immediately result in a net transfer of, or rapid transfer of jobs from China's export-orientated eastern seaboard back to the United States, which obviously from the US perspective is what would be intended. Instead, the Chinese economy would adjust to restore competitiveness, probably through enforced pay cuts. The nominal exchange rate would rise, but the real one would remain much the same. And indeed, the real exchange rate is appreciating at the moment quite substantially. There is the 5% which is allowed by the Chinese authorities. And on top of that, there's a relatively high rate of inflation against the US, and this is making very little difference to the US deficit. You may have heard already since, but there was a brilliant speech already referred to by Andy Haldane, who's the Director of Financial Stability at the Bank of England quite recently, at which he argued that far from easing or getting smaller, these imbalances are actually set to get a great deal bigger, almost regardless of what policymakers do to try and counter them. And this is because both in China and other parts of the developing world, there are an awful lot of people who are about to enter the prime saving age cohort. This is the age of roughly between 40 and 60, when people are prone to save most because their earnings are relatively high against their spending. It's also the age at which you naturally begin to think about how you're going to provide for your old age. So in other words, the savings excess in China and many other developing markets is just going to get bigger and bigger as a result of demographics alone. The same sort of point has been made by Stephen King, chief economist at HSBC, in his book, Losing Control. China continues to grow much more rapidly than the developed West, as seems likely. Then logically, its share of world savings, already at around 20%, is going to grow to almost whatever you do about it. So what I guess I'm trying to argue is that there is nothing unnatural, perverse, or unusual about imbalances. They are simply an economic fact of life and a natural result of globalization and trade. I mean, they're very common within economies, as we know, both between generations and between regions. Nor is it that uncommon, really, for capital to flow from what are considered poor regions to rich regions. If you just think about what used to happen in Britain, where the savings of relatively poor people in the north were intermediated through building societies to finance house purchases down in the south by relatively rich southerners. That's an example of it. And admittedly, internationally, these imbalances have become very, very large, although they've shrunk a little bit during the course of this crisis. But then again, the world has never been more interconnected than it is at the moment, nor does trade in such a large proportion of total output. So the trick is not to waste our energies trying to eradicate them. That may be impossible and therefore futile. And certainly it would be highly destructive if we were to attempt to do so by imposing trade barriers. Instead, we should focus on trying to limit their potential to cause instability. And that means a much bigger push for international monetary and financial reform than we've seen today. And this week we've had one very encouraging sign of progress. Under the Basel III process, there's now been international agreement to enforce greater capital requirements on the banks when one country foresees a credit bubble developing in its own jurisdiction. And of course Martin himself is very involved in this country. He's a member of the Independent Banking Commission, and we expect to see plenty of very worthwhile reform coming out of that. Once again, these destabilising flows of capital are very likely to get worse and not better. Now, countries could attempt to solve the problem by shutting down globalisation altogether and retreating back into largely closed national economies. But I think we would all agree that that's the wrong way forward. So, in conclusion, what I'm saying is that we better get used to accepting these trade imbalances, trade and capital imbalances, and instead about how to deal with them, how to cope with them, and prevent their destabilising results. Thanks.
Okay, so you have to take the unprecedentedly high global imbalances are just a reflection of unprecedentedly high level of global interconnection. Roger, what do you make of that thesis?
Well, something rather different, as you might imagine. I'm going to try and do three things. First of all, to try to lay to rest some misconceptions about this issue, some of which I think have already received an airing this evening, some have not. Secondly, to say why I think global imbalances do matter, seriously. And thirdly, to say a few words briefly about what can and should be done. The first misconception I want to lay to rest is the idea that surpluses for rapidly growing emerging markets are inevitable. And I think much of what Jeremy has said is tending in that direction. If that were the case, I would like someone please to explain to me why India doesn't run one, which is growing at very nearly the same rate as China and happens to be poorer on a per capita basis. In fact, India has been running a substantial current account deficit. I'd also like someone to explain to me why before 1997, this builds on Martin Wolf's point, China didn't run a substantial current account deficit from year to year. Indeed, her trade was roughly balanced, as indeed was the trade of many other emerging market countries in Asia. The notion that it's inevitable is just plain wrong. The second misconception, I think, is that this has nothing to do with government, but it's all cultural. People point to the tendencies in China to save a lot, and we know why that might be true, adequate social security and so on and so forth. And it is true that China's personal savings rate is very high, something like about 30% of household income. Again, however, the facts are a bit inconvenient, really, because India's personal savings ratio is also about 30%, with a rather different result as far as the current account is concerned. And moreover, the Chinese haven't, as it were, become more Chinese over the last 10, 15, 20 years. They've always been Chinese. All those cultural factors that you might adduce were true also before China changed with regard to the current account experience, as Martin said, around the time of the Asian-Russian crisis. In fact, a substantial part of what needs to be explained and possibly changed in China is nothing whatever to do with the personal sector and a lot to do with the corporate sector and the government sector. Indeed, this is where the increase in the surplus has come from. It's come from an increase in the savings of the corporate and government sector combined. The third misconception is this is linked. This is somehow to do with what the Chinese people ordinarily want, and that therefore you shouldn't interfere with the outcome. It isn't the result of what the Chinese policy people want, it's a result of what the Chinese government wants. The surplus is the direct and immediate and predictable consequence of economic policy. And economic policy in two respects. First of all, of course, with regard to the exchange rate. After all, if this were just normal, an expression of what the people want, then why exactly is the Chinese central bank intervening on the exchanges to hold the renminbi down? This is a direct act of government policy. And so also is the attitude to corporate surpluses and the level of the government's own financial position with regard to borrowing. The next misconception is the idea that nothing can or should be done, or it doesn't really matter about current account surpluses in these countries, because they're just a natural concomitant expression and result of capital account deficits. The capital account drives all this. If you've got a capital account surplus, i.e. saving, then you're bound to have a current account deficit. I think this is one of the worst examples of accounting leading you up the garden path, because you could just as easily say that the capital account deficits are the direct result of the current account surpluses. In fact, these two things are caused, occur, manipulated simultaneously and symbiotically. Change one and you change the other. And I guarantee to you that if the renminbi exchange rate were to rise very substantially and or Chinese domestic demand were to grow very substantially, then both the current account surplus and the capital account deficit would miraculously be reduced. So that's as it were, the end of my having a go at misconceptions. Now briefly let me say why I think these imbalances really matter. Let me say first of all that I think in normal conditions they needn't matter that much. That's to say there's an argument to the effect that if countries like China, for whatever reason, want to do all this saving and provide us with an awful lot of cheap capital, we should just lie back and enjoy it. Even then, in normal conditions, I don't think that's quite the end of it, because there are implications from a situation in which they accumulate net overseas assets, namely the fact that we accumulate net overseas liabilities, and that there are financial consequences of all this, because for their surpluses, of course, there are domestic deficit units. Are those deficit units capable of, in the long term, financing those deficits? And if the country means anything at all, as opposed to quite simply the sum total of the people and companies that reside in it, if there is such a thing as a country with a country's national interest, then isn't there an issue, therefore, about national wealth being accumulated or run down? And you think we perhaps ought to consider that we've got an interest in this notion, rather than simply allowing our extent of national wealth creation or diminution to be determined by what the Chinese and others want. So even in normal times, I think there are some issues, but they're not really the big ones. The key thing is that we don't live in normal times. In particular, because of past fiscal profligate policies, government debt levels in most countries of the West aren't consistent, I think, with the idea of responsibly using these excess savings supplied by China massively to expand government borrowing. In normal conditions, that might be possible. It would be a reasonable thing to do. They're providing all the money. What better opportunity to have a huge investment in public sector infrastructure? Use the money to do that. The trouble is that the fiscal numbers in a whole range of countries in the West, and I would put Britain into this category as well, are simply too overblown, and that policy would be too dangerous. Moreover, we've just emerged from a banking crisis, whereas Martin said or implied huge sums of money, much of it provided ultimately by the Chinese and others, were channeled into unproductive uses, a waste of resources. Do we really think that the appropriate response to these surpluses is to allow the banks and others to pump out yet more money? And if they wanted to, do we actually think that the private sector is in a position to respond? The answer, surely, as far as consumers are concerned in any case, is no. The one great hope here, I think, is the corporate sector. One could imagine, I think, a substantial increase in corporate investment in the West, as it were, indirectly, largely funded by savings from China and other countries. But is that likely in current conditions? Hardly, I suggest, with the government under pressure to tighten fiscal policy and consumers in such difficulty. So what is the net result then? Well, the net result is quite simply that these surpluses of desired saving in China and elsewhere, effectively create unemployment in the West. They amount to exactly the same thing as what would occur if there were a sudden increase in the desired level of saving in our own domestic economies. And we all know from Keynes onwards what that does. It diminishes aggregate demand and threatens an increase in unemployment. And we're only avoiding that, insofar as we are in the West at the moment, because of the big increase in government borrowing, which Martin Wolf has referred to. If governments cut back on their deficits in response to these surpluses, we would land up with a very depressed economy and a very high level of aggregate demand. Economy and a high level of unemployment. What can be done? Briefly, I think, as far as Britain is concerned, not a lot. On the question of exchange rates being inadequate to address the problem, I don't think this is quite right. The appropriate policy for China and the other surplus countries involves a combination of a higher exchange rate and expanded domestic demand. One without the other probably won't be enough. What could we as Britain do to bring about that result? I think very little, but we're lucky to have a flexible exchange rate so that, and to be able to get away with letting the exchange rate go. The country that really is in the firing line that we've got to look to for some sort of solution, if there is such a solution, is the United States, which in many ways doesn't have direct control over its own exchange rate, not least because the Chinese manage their currency, and other countries do, against the dollar. Where will all this lead? Well, my own view is very strongly that if nothing is done about this problem, while the US economy remains fairly depressed, I think it will lead inevitably and disastrously to a rise in protectionism.
Good, thank you. Strong stuff there. So, the last word, Andrew, your take.
Okay, well, my task on this particular occasion is to provide a number of times the voice of rigid orthodoxy, being balanced, what would otherwise be an imbalanced discussion. So my case is going to be the global imbalances can be symptoms of problems, specific instances of more general undesirable things, but are not particular problems themselves. And that specific action to try to eliminate them, since they're really mainly symptoms, is, to use an example close to Roger and my own heart at the moment, a bit like thinking you get rid of your flu by breaking your thermometer. So, forms of global imbalance, there are different things that people mean by global imbalances. Sometimes they mean differential growth rates or wage levels or GDP levels or budget deficits. Really, most people mean differences in private sector debt levels, savings rates, and the trade balance or capital account balance differences. Or perhaps what they mean is those last two things, except insofar as they're properly explained by the first three. So, normally, one might think of all kinds of other types of imbalance, people lending money to each other, as being in all kinds of normal settings to be relatively harmless. Private lending for mortgages, business loans, that creates an imbalance between the lender and the borrower. There could be regional differentials, so you could have systematic or quite extended periods in which one region of a country or an economy tends to be a provider of capital inflows to another region. So it was mentioned before, the possibility of people in the north saving and providing funds that were then used to lend for houses in the south. More debatably, people might think that relatively few people, I think, would be as agitated if what you had were global differentials that reflected differences in growth rates, growth rate prospects. So, for example, if China were the borrower and Europe the lender, then it's not so clear that we would object, right? Because what we might think was going on there was that China was growing faster than Europe. So, because in the future China was going to be richer because it was growing relative to their relative position today, because it was growing quite fast. That would legitimize them borrowing now and paying back the money later when they were richer. But there are a couple of key cases to think about when imbalances are harmless, which are more debatable. So I think the following two is particularly important. One is when there are changed growth expectations, and the second is when there are issues of collateral gathering or low financial development in high growth economies. So let's take that case. Each of these two kinds of cases can justify situations in which slower growth countries borrow from higher growth countries. So they're particularly relevant cases. So let's take the changed growth expectations case. So suppose, for example, that we had an economy that was ticking along, growing at 2% a year. That was what we thought was the sustainable growth rate of this economy. And then suddenly we change our mind and we think it's perhaps growing at its sustainable growth rate is 3% a year. What's going to happen there? Well, what's going to happen is that our view is that the long-term sustainable growth path of that economy is going to change. That's going to justify us having an increased capital stock associated with that higher long-term level of output. And that's going to justify us having additional investment in the short term. So it could well be that that effect, right, that changed view justified us borrowing as that 3% growing economy, now relative to a 2% growing economy, even from an economy that was growing at 6, 8%. Because that change was enough to justify a capital inflow. In general, I think that there's a point, so that particular illustration gives us the point that what we call unsustainable imbalances, right? So the one that I identified there is certainly unsustainable. It's only going to be sustained, that capital inflow, until we reach the new level of capital stock associated with our new equilibrium higher level of output that we'd expected. So it won't go on forever. It'll go on until the imbalance is resolved, that is the imbalance between the capital stock that we have and the capital stock that we ought to have, after which it will come to a benign end. So the point that I'm trying to make there is that often what we call unsustainable imbalances in flows reflect a correction. They're the optimal way for us to correct an imbalance in a stock. In this particular case, that the capital stock might have been too low. So for example, let's make that more concrete. Suppose that in the mid-1990s, early 2000s perhaps, one's view of the sustainable growth rate of the US economy had changed. Suppose that one had thought that it was growing at a certain rate, and now we have, with internet or some other kind of positive shock, we start thinking that it will grow faster. That would make it legitimate for us to have some capital inflows into the US to take account of the new opportunities. And as I say, that might be enough, could be in principle enough, to justify borrowing even from an economy that was growing faster than that. A second kind of a case, suppose that you have, and this I think might be relevant to some of the differentials, say, between India and China. Suppose that you have a situation in which the property rights for international investors were relatively poor. Right? It could be that you had an economy which was growing quite fast, but international investors would have relatively little confidence that their monies wouldn't be confiscated if there turned out to be any kind of a problem. So that, even though that was a relatively high growth economy, it might find it relatively difficult to borrow, perhaps until it itself had accumulated some international assets, which it could then, as it were, offer as collateral implicitly against the risk for international investors investing domestically. That might make it advantageous if you were, say, China, and people worried about whether you, because of your communist past and so on, whether you might confiscate some of their money if there were international investment, to acquire assets abroad. It increases your longer-term prospects of securing international inward capital flows. Now, although these might be legitimate examples, illustrations in which capital inflows were, in which imbalances were positively virtuous, there's also a risk that they're symptoms, that these such imbalances are symptoms of the problem. So for example, suppose that I had the case, suppose that you had thought that your economy was growing 3% over long term instead of 2%, but actually it was only 2.5%. Right? What might happen if you discover that too late is that you might have gone beyond the point of the optimal capital stock, and then you might have to retrench. So the imbalance creates a risk of you being dependent upon a particular sort of expectation. Your growth expectations might be overly optimistic. Your views of geopolitical stability might be overly optimistic. Right? It could be that you would be dependent on the idea that you were going to have this relatively symbiotic relationship, say, between China and the US, and if things turned ugly, and you maybe ended up with protectionism or something of that sort, then the expectations on which you based the idea that those imbalances were justified might be wrong. A third, particularly interesting case, I think, is that in which interest rates are excessively low. Now, it's often said, and it is a general principle, that a trade deficit and positive inward investment flows are counterparts. Of course, they're counterparts. I mean, one can think of that in both directions, as Roger quite rightly pointed out. You could say, look, what you have is a capital account surplus, say, precisely because you're running a current account deficit. I'm not thinking, though, just of capital and current accounts here. Right? Let's focus on the narrower cases, because people often think of these as proxies. They think, what I mean by capital account is inward investment. It's really only true that positive inward investment and a trade deficit are counterparts, given a stable money supply. Right? And I think that this is important. So, for example, if there is no net inward investment, but you're running a trade surplus, then the stuff which you're selling is dragging more money into your economy than the stuff which other people, which you're buying from others. Right? So there's a net inflow of money into your economy under that situation. Your money supply will expand. To control this, one could use the additional money to invest externally, or you could, for a time, just accept the money supply expansion. Now you might think, well, that would cause inflation, but it might not. Right? It could be that there were situations in which if you had a sufficiently credible central bank, you don't have to act straight away. Because there's all kinds of ways that you can mop up excess money supply. You could do it by raising interest rates today, you could do it by raising them a bit more tomorrow, you could do it by raising them quite a lot the day after that. So you have lots and lots of different ways of honouring your credibility promise. And one thing that you could allow is the build-up, as it were, of a money supply imbalance, an implicit promise to raise interest rates higher and higher and higher, which was associated with this balance of payments imbalance. Similarly, if my money supply is expanding but without inflation, so because of, say, I've got a temporary stimulatory policy, an incredible inflation targeting environment, that might lead to asset price rises, leading to investment inflows. If the rate of rise in asset prices is expected to be sustained, and that rise is more rapid than asset price rises internationally. So what am I saying there? So if I have a situation in which I decide to run interest rates very, very low for an extended period of time, there are conditions under which that itself could be a driver of an imbalance. Now, what am I trying to say here? Well, the lesson might be that large imbalances can be justified, especially if they're the result of medium-term sustained differential growth rates or changed growth expectations, but they should be treated with caution or skepticism because they might be the result of over-optimism of various sorts, say concerning growth rates, or perhaps they're a symptom of you running excessively low interest rates. Now, but they are symptoms, right? You don't get rid of your fever. I'm not going to get rid of my fever by breaking my thermometer. They're a symptom. They tell us that we're getting something wrong. Now, another thing, this is my last kind of case, is that there are instances of more general problems. Just a brief case here. An imbalance obviously arises from savings or deficits involving debtors. Excessive indebtedness undoubtedly can be a bad thing. But global imbalances are just one form, right? Therefore, perhaps, of indebtedness, owing money to foreigners rather than domestic players. But if what you think you do is to reduce borrowing opportunities by reducing the capital pool, by limiting global capital flows, what you're doing is reducing indebtedness, which you might think is a good thing, but you're reducing indebtedness by reducing the efficiency of the financial system. You're saying, I want to get rid of debt, so I'll do that by making all the banks go bust, say, for example. That would be an extreme version of this. I have to say, I don't think that that's a particularly desirable way of addressing problems of over-indebtedness. So my overall message is that global imbalances are really the international version of borrowing, lending, investment. They can be symptoms of a problem, overly low interest rates, or instances, say, over-indebtedness, but they're not special problems of global imbalances. Now, the real case against me is that are they the thermometer or are they the fever? Right? You might say that a fever is a symptom of some underlying problem, but that if the fever is allowed to run out of control, it itself can cause its own problems. Now, so finally, insofar as they present any special issue that is connected with property rights risk and geopolitics. So there could well be, it could well be that if you're running very large global have very large imbalances for an extended period of time, then that creates temptations to nationalise or confiscate foreign-owned assets, to impose losses on foreign debtors, to impose special taxes on foreigners, and so on. But I think foreign investors should be facing those risks with their eyes open.
Brilliant, thank you. Powerful stuff. So, at this point, we turn things over to you. If you want to ask a question, put your hand up. There is a roving mic which will come flying to you. It would be very helpful if you can say who you are and where you're from as well. And if anybody who is currently lurking at the back would like to get a seat, please do come forward. There are seats at the front, certainly. There's more room. You can take a pew. So, there is a question from a gentleman in the fourth row there. We're probably going to take a couple together, if you don't mind. We'll take one there, and then there is a lady in the third row back on the left.
There's one more asymmetry that nobody ever quotes in the context of China vis-a-vis the rest of the world, which is not only the currency, and that's the fact that there isn't a really organized labor pressure, and therefore there's no pressure to have a social safety net. That clearly must be a contributing factor to the fact that demand is insufficient. And that may be observed perhaps in other countries in different ways. You know, part of Saudi Arabia surplus goes regularly to satisfy the needs of a paternalistic distribution to the wide population. So I really wonder whether putting the pressure on the currency only, rather than on both China and India developing far more quickly than their politicians have any commitment commitment to the creation of pensions, medical care, and so on.
Very good. There is a lady just in the third row there as well.
Thanks. Sarah Buckley from the ICAW. The G20 seems to be becoming less effective every time it meets, and the Doha trade round is stalled. If we do want to curb or control imbalances, what are the most effective available international institutions to do so?
I think we might take one more question. There's a gentleman in a green tie in the fifth row back there.
Michiel Remmers, I work at Barclays Wealth. Could the other members in the panel, other than Roger Bootle, please answer the question what we're going to do to prevent trade wars, trade barriers being brought up? Because we hear Brazil now last week, we hear lots of issues, and the potential consequences of this are going to be disastrous. How are we going to prevent these problems from occurring?
Very good question. So, who wants to have the first stab at that? We might have the questions up if you want to take one each. Martin, do you want to?
Okay. I think the first question, I think the first question is based on, in my view, a very common misunderstanding. And what I'm going to say underlines Roger's very important points. Didn't have time to. Almost everything that is said about what goes on in China is wrong. On everything. And this is particularly true. There is nothing extraordinary about Chinese savings in the household sector. The household savings rate out of disposable income is well in line with what you would expect of a developing country at that level of income, which, by the way, normally doesn't have a complete social safety net. It's about a third. The difference between China and all other relevant countries in history of any importance is that household disposable income is about 35% of GDP. Well, and that does relate to, in part, to the pattern of development in a profound way, and in particular, the extraordinarily capital-intensive pattern of development of the last 10, 12 years or so, which is linked to Roger's important point. It's a circle about the way the Chinese corporate sector has behaved. So if you want to fix the system, you have to deal with what is quite simply the most quote-unquote capitalist or state capitalist economic system there has ever been. What's going on in the household sector directly is not surprising. Now, shifting income from the corporate, quote, government sector to households is really important. Now, really important, not only because that would affect these things, that second thing, because it would dramatically increase the welfare of the vast majority of Chinese, most of whom have got actually rather little out of growth in the last 10 years. Now, can that be done with the current political system and structure of China? Probably not. But it's clearly in the interest, as Roger has stressed, for the Chinese people it should happen. At present, the Chinese people have indirectly accumulated claims on the rest of the world through foreign currency use. There's nothing to do with private behavior, I'm sorry, Andrew, of $2.5 trillion, which is 50% of GDP, which is the equivalent in the UK case of the UK government sitting on 600 or 700 billion pounds of external assets yielding zero. I think you can see the point. So that's the core problem. What we are dealing with is the interface. In this case, there's many, the interface between an economic system which is hyper-corporatist and hyper-mercantilist and the rest of the world. It has nothing, zero, nada, to do with normal market forces.
Any other takers on any of those questions?
So that's also my response to Jerry. I can go on with a lot. This private household saving is just nonsense. 65% of the savings of China are government and corporate.
Well, mercantilism is, as Martin points out, I mean, that is the route that most countries, developing countries, choose to enhance themselves and push themselves forward economically since time immemorial. it's being done, and it's being done again by China. But I don't think you're right that there are no cultural issues involved in a Chinese propensity to save. It's perfectly true that the big growth in saving has come over recent years from the corporate sector and not the household sector. In a sense, the household sector has infected the corporate sector with its own propensity to save. It's not entirely clear why Chinese corporations do save their money rather than pay it out in dividends. But I would suggest quite strongly that that is a cultural phenomenon, and it's to do with a high propensity to save, which is kind of hardwired into the Chinese psychology. It may also be to do with lack of ready access to credit, which means that you want some money in the bank for a rainy day or for some investment project that may come up at some stage in the future. So you hoard your cash rather than pay it out in dividends. I would disagree. And I found myself wondering too why India is different from China. And the way I would explain it is that it's simply at a very different stage of development. It's a much poorer country. For a start. It's a much younger country, and that may also be very significant. And of course, Indian people have a lot of children, so they may not have such a high propensity to save as the one-child policy seems to have prompted in China. So I would think there are quite strong cultural reasons why China is where it is at.
Roger, I was going to try and encourage you to pick up this point. I mean, you say you want something to be done, and it's argued that the G20 is a rather useless vehicle for doing that. So what is going to happen?
Well, I very much agree with the idea that the G20 is a useless vehicle for doing something about it. We didn't give enough attention, I think, today so far to the breadth of this issue. It isn't only about China. As Martin started off by saying, you've got the oil producers running massive surpluses, including, of course, Russia and Norway. You've got Switzerland running a huge surplus at all, and within the European Union, although within the Eurozone overall is fairly balanced, of course, Germany is running a very large surplus. So one approach to this question might be to try and look for a global solution. I think it simply won't work. The issues are too complex and the institutions are too weak. If there is going to be any progress, I think it has to be bilaterally between America and China, and if progress could be made, I think thereafter it would be relatively easy, and the word to stress there is relatively, to get some other deals and changes of policy in the rest of Asia, where China led. I think the others would probably follow. But the key, I think, is not so much browbeating China as trying to exert leverage on those parts of the Chinese leadership who already see the problem and want to change, as Martin said, in China's own interests. The key thing is, so it's not a question of the West or America saying, right, China, you must do this to help us out, or else. It's a matter of getting them to see whether China's own interests lie, and there, as always, there are different parts of the leadership that seem to see that and others who don't. Now, how does one best exercise that leverage? I suspect initially, first, anyway, behind the scenes, but I can see the case, and Paul Krugman has made this argument, that ultimately America needs to get tough, and the threat of protectionist action might be the thing which, as it were, strengthens the hand of those people who want to do something. This is a very dangerous road to have to go down.
Andrew, you sort of ended on the kind of geopolitics.
Well, I think so. I think it's important to distinguish, first of all, between saying that there's some general problem with global imbalances, and so saying that you want some general international regulatory framework that limits them, and criticising stupid monetary policy in China. Right? I mean, one might very well have all kinds of criticisms of monetary policy in China, and you might say, look, we can see how stupid it is by seeing the global imbalances. Well, I was the one who said that global imbalances might be indicators, might be symptoms of a broader problem. And of course, it may well be that if the Chinese adopt a stupid monetary policy, then that damages their demand, and so damages their demand for exports from us. So there'll be certain sectors of our economy that would care about that as well. But it might also mean that what would be an ideal monetary policy regime, an ideal monetary policy framework or specific policy to take if the Chinese weren't running a stupid policy would have to be changed. Right? Your monetary policy framework might have to adapt to the fact that a big player in the international financial system is behaving in a stupid way. But if you're thinking about how to prevent trade wars, I mean, obviously I don't want anything particularly done, so in terms of this question about most effective institutions, I'd avoid it. Preventing trade wars, I think the key thing about preventing trade wars is not to try to over-pressurize the Chinese on things which they will consider to be basically their business. Right? How they run their monetary policy, you might offer them friendly advice on what you thought was a wise or a stupid monetary policy, but getting all macho about it, as some people in Congress have done, that kind of getting overly exercised about the global imbalance, I think that's a good route to the possibility of trade wars. So one kind of way forward, I think, in terms of preventing trade wars would be to fixate less about criticising matters which I would have thought the Chinese would consider to be their own damn business.
Very good.
Exchange rate always concerns more than one party.
Exactly.
Always.
So there's a gentleman right at the very back, if we take him, and then one a bit further up.
Stephen Hill, I'm a member of this institution, so maybe I could just bring this to asset price issues. I was very taken, Martin, with your initial analysis of how global surpluses are attracted into asset prices, and you chose particularly Spain and Ireland, which to my mind are kind of slightly anomalous because actually they're unique countries with almost unconstrained land supply, whereas in the UK we're very constrained, partly through a mix of planning control and a kind of cultural aversion to new development by the already housed. And some of the kind of consequences of that seem to have been very serious. Huge explosion in asset prices, so the relationship between average incomes and average house prices has gone anything up to 8 or 9 times, so very unaffordable for the vast majority of the population. Over a period of asset price inflation over about 25 years, clearly more debt than would have been paid if house prices had moved more in line with consumer price indexes, and some figures looking at sort of 1980 to 2005, something like £600 billion of kind of excess debt. And I think in 2007, one of the big economic institutions was saying that house prices in that year were equivalent to something like 4.4% deficit on GDP, £50 billion a year. These are kind of big drags on other parts of the economy, of investment in more productive things. So maybe you could say something about that. And the other thing that you've been talking a lot about has been current account deficit, whereas it seems to me it's also about cumulative deficit. And actually part of the political narrative at the moment is about how you cut current account deficit and plays out public debt as the kind of the big thing. Whereas it seems to me that what has happened, if you look at, there was a useful report by PwC last year, is that if you look at the proportion of public debt against other forms of debt, it's really quite small. Something like total debt in 2009 was something like £7.5 trillion, of which less than £1 trillion is public debt, and nearly £3.5 trillion is property-related debt. So I'm just wondering, whether we're kind of not focusing on the right thing in looking at the kind of snapshot of the current account deficit, and we should be looking more at accumulated debt.
Good question. There was a gentleman, we'll just take another one with you. In front of you.
Rod Dower, Industry Forum. Martin Wolf has said that a big contributing cause of the crisis was building unwanted or unneeded houses in the developed world, in the United States. And Robert Peston, another economic guru, has said recently that there are 85 million empty houses in China. And I wonder if this means that we can expect a Chinese banking crisis anytime soon.
Very good. I think that two very similar questions, both very good ones. So I was struck by the way that both Martin and you Roger, ended on this point, the fear that they've gone into unproductive investments, which seems, in the UK case, a bit odd. Who wants to sort of take that one first?
Yeah, I think these are wonderful questions and get to the heart of some very interesting questions about misallocation of resources. I wouldn't, obviously, I'd have a very different perspective from Andrew in that he thinks of all policy mistakes are monetary. I certainly don't think that. That's no surprise. I don't even think we can define what money is. So we have all sorts of problems there. But clearly, all the problems we're talking about are related to policy mistakes in some very deep way. It's just the nature of the policy mistakes is quite difficult to define. That's a fundamental point to understand. On the specific issues, I think you've raised what is to me a fascinating question about what happens if, and I won't sort of go into the different mechanisms, if you have two different situations. One, a country in which there's initially a very large inflow into an optimism about the prospect for house prices, and I won't go into why that might be. That's just a fascinating set of questions. It's not to do with growth, I think, but we'll leave that aside. So you get an estimation, and in the short run, with a given stock is fixed, house prices start rising a lot. And that happened in all these countries. Then you have two different sorts of economies, very crudely. Economies in which supply is elastic and economies which it isn't. We are clearly very solidly in the latter category. It is extremely difficult to expand supply. So prices go through the roof, as indeed they did. People borrow lots of money, but supply doesn't expand, construction activity doesn't expand. In fact, the distortion in terms of misallocation of investment resources is relatively small in this case. We just have a large distributional effect. In our case, a very large distributional effect, which is essentially intergenerational. And then you end up with, at the end of this process, with very high prices, the thing goes down. And I suspect, because there isn't this huge overhang of unsold houses, the result is, this is just my guess, we're going to have 15 years of basically slowly whimpering down real house prices. That's happened in other countries, by the way. Just sort of miserable. But you don't have a collapse. In countries where you've got, so that's one scenario. The other scenario is what's happened clearly in the US, Spain, Ireland, is you go out, land is available, certainly. It's the point I used to make to all my American friends. You can't double house prices in the US. Have you suddenly run out of land? So of course it's not going to last. You get a huge overbuilding, colossal excess capacity, and the house builders all go bust. The people who've lent to it, and the house prices collapse when people run. Just go through the floor, and you end up with a massive quantity of very, very bad debt. And foreclosures, and this is what happened in Spain, has happened in Spain, what happened in Ireland, and the banks go. They just go bust. So in this sense, having our absolutely rotten housing supply system seems to me to have saved us from the worst of the crisis. The downside is that the future generations of British purchase of houses in this very constipated market are going to find it very difficult to get houses at reasonable prices. Well, in the US, actually, if you're coming into the market now as a young person without a house, it's great. They're all so cheap. So it's a question of which way you screw up. And we've screwed up in an interestingly different way. Now, I haven't gone into the mechanism of how this happened and so forth. I think that's very... Now, the other question that was asked is, could China go the same way? The question there, the answer to that question is twofold. The first answer is, well, the difference between China and us is there is reasonable reasons to expect the movement of something like 400 million people or so from the rural areas into the towns over the next 20 years. And if they haven't built these houses in a really stupid places, in some cases they have because I've seen them, these houses will end up being filled. And that's really rather important difference from us. Because we don't have 70% of our population out in the rural areas trying to get into town. So that's quite good. And it helped further by the fact the economy is growing, they're getting richer. So they're building ahead of demand. The second point about it is, yes, it's quite a large misallocation, but in a country that is investing as much as China is doing, it's still quite a small part of the capital stock. So there's a reasonable chance, I think, the banks won't be destroyed by it. So those are the optimistic views about China's future, but there's a wonderful debate going on about whether the Chinese banking system will be bust by this. My own reasoning on the two reasons I've given now is probably not. Those who hope that China will go bust, the Chinese banks will go bust over this, will be disappointed. They're not Japan 1990, as I say, they're Japan 1965. Very important difference.
Andrew, key to go.
Yes, so first of all, I want to say that I don't buy at all this story that so if I went back to about 2004, then there was a bit of an argument being made that the house price rises that had occurred had been justified by things like undersupply, problems of rigidity and problems with the planning system and things of that sort. In fact, many people, to that point, claimed that there were deficits, that there were many parts of the country where there were more families now than there were housing. In fact, the official statistics suggested that at the time. That during the 1990s this had occurred, and so that was why house prices had risen. So those of us who said at the time house prices are too high and that there will be a housing crash were one of the criticisms offered to us. I find it incredible that people are still trying to offer this as some sort of argument, as a serious case, when we had 22.5% fall in house prices over a period of about 18 months. The idea that house price rises was some inevitable reflection of undersupply, I just think is ridiculous. I mean, it's a ridiculous thing that people keep claiming. And yet, so many people were so trapped by the momentum of this idea. Another thing, just to get note on this argument, people did not catch up with the reality of the census data. The census data, when it came through in 2003-04, told us quite definitively that during the 1990s, the expansion in the number of households was more rapid than the expansion, was less rapid than the expansion in the number of houses. So in every region, it wasn't just even localized, in every region of the country, the surpluses of the number of houses over households had increased. This just was not a factor. Some kind of pathological shortage of housing was not a factor, not a material factor in significant house price rises from 1998 onwards. House price rises were, of course, initially partly a symptom of some of the same sorts of factors that drove other imbalances. So, for example, if you have greater optimism, if you change your view about the future growth rate of the economy, you're going to change your view about your future wage prospects, and that's going to justify you paying more over your lifetime for your housing, because you think you're going to be richer. If, of course, we amend our view subsequently, then that, of our future growth and hence wage prospects, that will be a reason for house prices to fall. But on the other hand, some of us might have felt that looking at the data, we could see that the house price rises had just gone beyond anything plausible that could be justified in terms of greater employment stability or higher future wage prospects. And so we criticised them, saying that house prices would fall. So I just don't buy this as a story. I think that the right way to think about high house prices was that they, like imbalances, were indications of broader problems, named specifically that I would focus on that people were over-optimistic about the future growth rates of developed world economies, and that, of course, there were big house price rises, similar to those in the UK, in many economies that had no planning constraints whatever. And yet, we still seem to say that it's something to do with planning constraints. I think that they're symptoms of the same kind of problems of excessive optimism and excessively low real interest rates. Just going back to an earlier point, that's a bad combination, because over the medium term, there has to be a relationship between the average real interest rate and the average sustainable growth rate of an economy. On an equilibrium path, when the one rises, the other must rise. If the economy is growing faster, then the equilibrium level of real interest rates will be higher. So you can't at the same time have that you have a material fall in the real interest rate and a material rise in the expected growth rate of the economy. That ain't going to happen, and it should be a warning sign.
Roger, I remember you writing about that there had to be a house price crash.
Yes.
Many of us here were in that camp.
Yeah. I think we were partly vindicated for a while, and of course house prices rose again, but I suspect there'll be ultimate vindication not far from where we are anyway, when I first heard the gentleman over there mention that there were supposedly 85 million empty homes in China, I thought, well, he was going to suggest that we solved our own homeless problem by decamping over there. But instead he went on to ask whether there could be a banking crisis in China. And the Chinese banking system is undoubtedly extremely ropey, and I don't think, especially with regard to this fact, it's to do with the fact that this has not been a fully efficient professional industry. It's been essentially state-run. The price mechanism hasn't worked properly in this economy in any sense for many, many years, and still effectively the government allocating credit. And it's normal in any case in rapidly growing countries. The United States in the 19th century, for example, they have periodic financial crashes. So I should have thought a banking crisis in China is a fair bet at some point or other. However, there's one big difference, which is economic growth. When the sustainable growth rate is 8, 9 or 10%, you can get over quite a few crises actually comparatively well. And so many emerging market countries have crises every few years. Turkey is another example of one which is able to bounce back pretty quickly from its various financial crises. The thing which really clobbers the countries of Europe which are suffering banking crisis, they ain't got any growth. If you've got heavy indebtedness and banks completely novel and asset prices at the wrong level and your underlying growth rate is very low, it's quite difficult to get out of that problem. Now, secondly, on the issue of the misallocation of resources in the UK, and Martin touched on this, it is of course right to say that we didn't have a substantial misallocation of resources in the sense of a huge building boom. Martin made it right, this would prove to be a good thing, I'm not sure. But it seems to me in a more general sense there was a big misallocation of resources that resulted from this, because the result was essentially the creation of a mass delusion about prosperity. A delusion on the part of the British people and a delusion on the part of the British government. The British people borrowed and spent too much, and so did the British government. A result was we had excessively high consumption for too many years, and we paid insufficient regard to manufacturing in particular. We ran with an exchange rate that was much higher than it should have been for far too long, which is why we're ending up in the position we are now. So I would argue that there's been a huge distortion in the UK, which is partly bound up with these imbalances and the consequent policies pursued over here. We essentially boosted domestic demand and we allowed domestic demand to grow very strongly to make up for the weakness of the external sector. And for a time, everything looked hunky-dory. But in fact, this was always a pack of cards.
Yes. This issue of why so much of the Chinese surplus flowed into unproductive assets is a really fascinating one. Of course, the money went mainly into US Treasuries, also a little bit into asset-backed securities, and the result was it depressed long-term interest rates and helped prompt the asset price bubbles we saw in housing and some other sectors. One of the answers to this question, besides the obvious one that everybody thought that these were extraordinarily safe investments, virtually risk-free, and that's where a central bank would therefore invest its reserves. But the other answer is that they can't actually, that the money can't actually go anywhere else. If the Chinese started to buy productive assets, i.e. US companies, there would be a storm of protest in Congress, as on a few occasions they've tried, we've seen. And this is a very interesting question for the future, because of course if Haldane is right and these surpluses continue to grow, there will be growing pressure from the Chinese and others to buy productive assets. And that'll be a big test, it seems to me. Are the US Congress willing to allow communist ownership of some of their major companies?
This is a test, we know the answer.
Well, the answer is no, yes. The other issue that you raised, which is absolutely fascinating, is the focus on current account deficits and whether we should be thinking much more widely about the totality of economies in the way we police them. And this, of course, a huge issue, a live issue in Europe at the moment, because we saw with the Irish and the Spanish that they were in surplus, fiscal surplus, in the run-up to the crisis, and then suddenly they were polaxed overnight. They were polaxed. So you do have to take a much more holistic approach to assessing the overall economic health of the economy, and you're absolutely right that this involves looking at overall indebtedness, private debt as well as public debt.
Very good. So it's one of these classic and sort of slightly brain-melting discussions, like everything in economics, where there's sort of mass simultaneity and everything causing each other at once. It's an interesting discussion I thought we've had this evening, insofar as it is an example of proper political economy, the sort of overlap of sort of theoretical economic arguments and more political ones. We're about to run out of time any moment. I just wondered if any of the panel want to try to encapsulate or sort of pick up on any particular sort of point of data that would tip this argument for them, or to try and conclude this discussion, which I think has been an interesting one.
I'd like just to make one point, which I think there are an immense number of points, but we've come round to this. One of the issues that comes out, and I think both Jeremy and Andrew mentioned it, is, well, why should we care about this if we don't have an equal concern about essentially comparable flows within countries? It's an argument my colleague Samuel Britton makes. And I think the answer is very, very simple. Leave aside the politics, the economics are very simple. Within countries, if processes like this occur, which when they reverse, lead to the collapse of a region, there are very clear mechanisms of adjustment for the affected region. One, it's easy for people to leave that region to go elsewhere. Relatively, it's not easy, but it's certainly easier than to cross a frontier. And a second, certainly in most modern states, there exist automatic mechanisms of adjustment through the fiscal system, which cushion the impact of a cumulative collapse in income in the affected region. You just look at what's going on in the US now within regions as compared with what is now happening to Ireland. If you're at the end of a boom bust cycle, say your Ireland or Estonia, and the foreign capital disappears, you've got an implosion, a massive implosion. A depression is likely, a very severe one. Now, if you think you can adjust through that, and in theory it's possible, you wouldn't worry about this. That's fine, that's just what happens. But it's not, in my view, the same thing as what happens within a country. Because, as Roger said, countries are different. So this line of argument, in my view, is absolutely misleading. The transitions of capital across borders really do have different consequences because of a very different mechanism of adjustment. And that's, of course, the core of the Eurozone problem. And I'll just add one point which you made and Jeremy's picked up. Yes, of course, it's the point I've been making for 15 years, roughly. What the private sector does matters. If the private sector leverages itself up to the hill, not in my view, mainly because it rationally made a conscious judgment about its future income and all the rest of it. It's usually because of asset price spirals which drive everybody nuts. But never mind why. If the private sector makes a really serious aggregate set of mistakes, there could be a whole set of reasons, policy, whatever, this will end up as a fiscal crisis. That's what we've seen. And the fiscal crisis we had, in my view, is largely a symptom of that in most countries.
Is there a last thought out of the skeptic here?
I'll just say two things very briefly. One, of course, is that countries have an extra kind of adjustment, which is that they can adjust their exchange rates. The second is to point out that this business, the interesting point I was making that was being made earlier by Jeremy about Chinese investment in treasuries reflecting protectionism. The way I would put that is that it reflects protectionism in the first place. And I think that there is an intimate connection between the protectionism and these imbalances, but it's not all, the thing that I would want to say is it's not all one way. You can create problems through protectionism. It's a symptom of protectionism in the first place, and protectionism I don't think is a solution.
Interesting note to end on. You've all asked extremely good questions this evening. I'd like to thank again Pi Capital for making this possible, and also Brit for inspiring us to do it. And lastly, but not leastly, I would love to thank all of the panel. You've been exceedingly good this evening. I've learned a lot, and it only really remains to thank you in the conventional way. Thank you so much.